You wake up, you check your phone. Mortgage rates are up again. Credit cards are more expensive. Savings still earn almost nothing. And somewhere, far away from your kitchen table, the price of money just changed. Not because of a market crash, not because of an election, and not because you voted for it. Here's the uncomfortable truth. The most important price in the economy, the price of money itself, is not set by supply and demand the way you think. And the people who influence it most prefer that you don't notice, because once you do, the entire system looks very different. Right now, this matters more than it has in decades. Interest rates decide who can buy a home, which companies survive, how much governments pay just to exist. They decide whether debt quietly shrinks or explodes. And yet most people are taught a simple story. The central bank sets rates, markets react. Inflation goes up or down. End of explanation. That story is neat, it's clean, and it's incomplete, because the price of money isn't a single lever. It's a negotiation, a power struggle, and sometimes a standoff. Let's start with what everyone sees. Central banks announce a policy rate. In the US, it's the federal funds rate. In Europe, the ECB's main refinancing rate. This is the headline number. It makes the news. Markets move. But here's the first crack in the story. That rate isn't the price of money for you, or for most businesses, or even for governments borrowing long term. It's the price banks charge each other overnight. That's it. Everything, ilse mortgages, bonds, student loans, credit cards floats on top of that number. Saped risk fear, leverage, and expectations. So who actually decides where those rates land? This is where it gets interesting. Markets don't wait for central banks. They front-run them. Bond traders, banks, pension funds, hedge funds, they place bets on where rates are going months or years in advance. If markets believe inflation will stay high, long-term rates rise even before a single policy meeting happens. If they believe a recession is coming, rates fall on their own. Sometimes central banks follow markets. Sometimes they fight them. And sometimes they lose. There's a reason policymakers obsess over financial conditions. They're watching credit spreads, yield curves, currency flows, because if markets tighten too fast, economies break, and if they loosen too much, bubbles form. Now add governments into the mix. Governments don't just care about inflation, they care about interest payments. When debt is small, rates are a policy tool. When debt is massive, rates become a political constraint. The US now carries debt larger than its entire economy. Japan's is more than double. Many European countries never really recovered from the last crisis. Every percentage point increase in rates means billions, sometimes trillions, in extra payments. So when central banks raise rates, they're not just fighting inflation, they're stress testing governments. And here's the quiet part. If rates rise too far, something breaks. A bank, a pension fund, a housing market, a government budget. We've seen this movie before. In 2019, the US repo market froze overnight. The Fed had to step in quietly. No press conference, no speeches. In 2020, markets collapsed in days. Rates dropped to zero instantly. In 2023, regional banks failed, not because of bad loans, but because higher rates crushed their bond portfolios. Every time, the message was the same. The price of money can rise, but only up to the point where the system survives. Which leads to the uncomfortable math that if these systems cannot tolerate high rates for long, they can flirt with them, they can threaten them, but they eventually retreat. That's not ideology, it's arithmetic, and markets know this. That's why long-term rates often stop rising even when central banks promise to keep tightening. That's why inflation fears fade faster than the headlines suggest. The real controller of money's price isn't a single institution. It's the tension between credibility and collapse. Central banks need to appear tough. Markets need to believe them, but not too much. Governments need low rates, but don't want to say it out loud. So everyone speaks in careful language. Data dependent, temporary, transitory, higher for longer. Behind those words is a quieter reality. Money is priced not by purity of policy, but by how much pain the system can absorb before something snaps. Now, compare that to the public narrative. You're told inflation is a moral failing, that higher rates are medicine, that pain is necessary. Sometimes that's true. But medicine has dosage limits, and the people closest to the system, banks, funds, governments, know exactly where those limits are. That's why bailouts are never called bailouts. Why emergency facilities are temporary. why crises are contained. The goal isn't to end cycles, it's to manage them without losing trust. Because the final layer of control isn't rates at all. It's belief. Money only works if people accept it tomorrow. Debt only works if people expect rollover. Rates only work if people think someone is in charge. Once that belief cracks, control disappears fast. History is full of moments when the price of money stopped obeying policy. Hyperinflations, debt spirals, currency collapses. Those aren't accidents. They're moments when the hidden negotiation failed. So who actually controls the price of money? Not central banks alone. Not markets alone. Not governments alone. It's the fragile balance between them, enforced by math, masked by language, and stabilized by confidence. And the reason you're not supposed to notice is that once you do, you realize the system isn't designed for stability. It's designed for survival. At least for now. The question isn't whether rates will go up or down next. The real question is how long belief can keep doing the heavy lifting before arithmetic finally takes over.